Good morning, and thank you very much for joining us today. This panel discussion, as you know, will be dealing with impact and the role of technology on the continent. My name is Gbenga Oyebode, and I'm of counsel at the firm of Oyebode in Lagos. My co-moderator will be Karim Anjarwalla of Anjarwalla and Kana, ALN Kenya, and I am ALN Nigeria. The purpose of the panel is to review developments on the continent, take a look at the challenges that we're seeing, and essentially focus on what are the solutions that we can drive, what are the things that we can change in a world of impact, in a world of increasing regulation, in a world of changes. We'll be focusing on all these issues. And we have a panel this morning of 3 speakers. And I'm going to hand over to Karim to do some brief introductions and of himself and also the panelists for today.
Thank you very much, Gbenga. This is a panel spread across Cape Town, Nairobi, London, and Lagos. So truly Pan-African in nature. Welcome, everybody. My name is Karim Anjarwalla. I'm the senior partner with ALN Kenya, based in Nairobi. Absolutely delighted to have with us today Zachariah, George, Dario, Giuliani, and Folarin. Just very all the information was obviously in the packs that's been sent out, but just by way of very quick introduction, Zach is the MP of Launch Africa Ventures. I don't think I could count the number of early stage investments they've made, but I would imagine it's in the hundreds, and obviously a very well-known face in the venture space across the continent. The startups that he's invested in include Flutterwave, Bank, Mpost, Recomed. Dario is the founder and director of Briter Bridges, business intelligence platform, serving a really important need actually in a continent that's very diverse and oftentimes lacks the data that we all need to make informed decisions. And Folarin leads Google's startup ecosystem in Africa, really focused on empowering startups across the continent to work with, the best of Google's tools wherever they do business. I'll just set a little bit of context before I push back to Gbenga to kick off the Q&A. But obviously, over the last particularly 5 to 7 years, we've seen a massive change in the tech startup ecosystem in Africa, led, of course, I think, by Nigeria and South Africa, but also Egypt and Kenya, and increasingly with great companies and startups right across the continent. The amount of money has increased significantly. Data suggests, for example, that despite everything, the money coming into the tech scene in Africa in 2022 will exceed by 30 or 40% the amount of in 2021. Equally, there are big gaps that remain, right? Regulatory gaps, skills gaps, people gaps, and sometimes overtly strict or incoherent regulation. At the same time, Africa, unlike other parts of the world, is coming together. The AFCFTA heralds a big step, positive change potentially in the dynamic movement of goods and services across an increasingly more integrated continent. And obviously, technology is going to be at the heart of driving this to create a single digital market. At ALN, we believe deeply in integration. Our model is based on integration. We've been in 15 markets and growing for decades now. We think of Africa as a single market, as one region. And so for us, what tech can deliver for the continent has unmeasurable potential. What we hope to achieve, as you know, this is a 3-day session, a couple of hours each day, and then continues tomorrow, Wednesday, and Thursday. What we hope to achieve is 3 things, really: to spark an interest in collaborative continent-wide engagements aimed at unlocking the potential of Africa's tech ecosystem. 2, to understand some of the practical challenges facing tech startups in different sectors and different jurisdictions, and to explore, finally, workarounds and solutions to some of the challenges that we identify. So we all want to leave after these 3 days better informed and more knowledgeable. And just to summarize very quickly, after this panel today, we have one focused on the regulatory environment, particularly looking at FinTech. Tomorrow, we have a panel on FinTech, on InsurTech, on tech in general, and on health tech. And then on Thursday, we have 2 panels on fundraising, early stage and growth stage fundraising, including IPOs, including in US markets. So that's the plan. Gbenga, allow me to pass it back to you to kick off the Q&A.
And to kick off, we're talking about the pulse of tech on the continent. Giant strides that have been made, essentially around education, healthcare, particularly around FinTech. But I think it's also important to acknowledge some of the challenges that we face on the continent, whether they be challenges around infrastructure, whether there be challenges around regulatory behavior, or whether there are challenges around just the information gap or funding gap. And I would just like our panelists to speak to what are the real issues that they see on the ground. How do they think we can leapfrog some of these issues? As important as the continent is, and as the growth of technology on the continent continues, we do have to admit that these challenges exist. And I'm just wondering, and I'll go to Zach first and say, look, what do you think how do you think we should dimension these challenges, and how do we deal with them?
Sorry, sorry, I just lost connection for a second. Was that directed at me specifically?
Yeah. Well, for you to start off, Zach, really just to say that in the middle of all the growth that we see on the continent, and particularly because this is a continent that still has so much to do. Technology is obviously going to help us along the way, but we then continue to see significant gaps, whether it's infrastructure or funding, or even if it's just inconsistent regulatory behavior on the continent. And the question really is, how do we dimension some of these things, and how do we leapfrog them?
Yeah. No, I mean, there are lots of it's a great question to start off with. I think people need to realize that, and Dario and I have been on several panels together where we've hashed this out. I mean, venture capital in Africa is still an absolute minuscule percentage of the total amount of funding globally. It's less than 1%. It's about 0.7%. So while we celebrate small victories of us getting to almost touchwood $5 billion of VC on the African continent this year, it still pales in comparison to the almost 600 billion that we'll see this year globally. The second thing is the majority of problems that venture capital can solve in Africa are things that need to have solutions, not nice to have solutions. So the startups that we've backed as Launch Africa, the startups that our colleagues have backed and other VC funds are solving problems that have a real problem solution fit or a product market fit. And they serve populations in things like financial inclusion, infrastructure, as you mentioned earlier, food and water security, logistics and mobility. In a lot of economies, people don't understand the significance of what percentage of people's monthly income gets spent in things outside of just rent. So mobility and logistics, access to basic commerce, groceries, healthcare, etc. So when you use technology to solve these problems, it requires a seismic shift in thinking, a mindset. And that takes sometimes almost a generation to see. So although Africa still accounts for a very small percentage of venture capital globally, what we're seeing is the shift in capital allocations away from traditionally project finance, which is mostly impact and foundation driven. So you've seen massive World Bank, IMF, IFC loans to the African continent to project finance, and that's slowly being moved away into less asset heavy projects, so less capex heavy projects. So what you're seeing is the majority of VC funding in Africa still happened, but it didn't happen through VCs. So you're seeing less debt, less donations, because people have been are coming to grips with the fact that having a commercially viable, profit-driven enterprise that creates more sustainable jobs on the African continent than pure donor funding or foundation-driven funding, and to a large extent, DFI-driven loans. So that trend will only get better. And with the more success stories that you have of not just unicorn founders, I'm not a big fan of harping on unicorns. The more success stories you hear of technology founders that have been able to create sustainable jobs within their own startups and the broader supply chain of clients, suppliers, and partners, the more you'll see capital shift away from traditional asset financing into venture. And that's what I'm extremely bullish on. If you just look at all the jobs created in Africa by the top 50 tech startups, they're exponentially higher than what a similar sized organization would have created, if that makes sense.
Thank you, Zach, for that. I'm wondering if Folarin could just do a quick follow-up on that question.
Yeah, thanks, Gbenga, and thanks, Zach. Hi, everyone. I think what I usually do when I'm asked this question is I bucket them into four things, because the problem is also where the solution is. So we've conducted research over the years and seen that the four biggest challenges that startups face across the continent are the first thing being access to finance, access to additional finance, second thing being access to markets, third being favorable policy, and the fourth thing being hiring and talent. Right, so we'll kick off with the first one, the finance. I think Zach has covered it all in terms of the funding gap that there is. Earlier this year, we saw that I grew to learn that the UK raised 40 billion in funding last year, compared to the 4-5 billion we raised last year. If you look at the growth that the UK, for example, has had, we are 10 years behind them in terms of funding numbers. But in terms of the number of startups that we're producing, it's far more than they have or will ever have. By sheer number of the size of the continent, right? So the biggest thing is just that funding gap. Again, geographically and historically, where Africa is very far away from where the pools of funding are. So that's the biggest challenge we're seeing in the market now. So the solution is, obviously you can say, okay, throw more funding in the market, but it's not as straightforward as that. I'm sure we'll probably cover reasons for that later on. The second thing is access to markets. On one hand, yes, there's the AFCT agreements coming to fruition and taking shape. And yes, people talk about the size of the population, but also the size of the youth population. But what they don't factor in is that the tech landscape requires certain criteria to be met in terms of internet connectivity, in terms of smartphone access, and a bit more. And when you start to filter down with these sorts of criteria, you drastically reduce the size of the population that will probably that's your target audience or that can use your products, right? With that, so on one hand, yes, we can build, but the problem is you cannot lead for infrastructural challenges, right? The third thing being the favorable policy. Again, yes, access of AFCT agreements, But we're also seeing, for example, in Kenya, the Kenya Startup Bill, in Nigeria, the Nigeria Startup Act, and we're seeing more countries, more governments be a little more proactive in supporting the startup ecosystem, right? While that is good, it's still not enough, right? So I think part of the solution there is, again, the challenge is that the government still seem to be looking for how to eat from that tech ecosystem because they see tech as the new oil. So it's vibrant, it's the new coal. So they're wondering how they can also, I guess, get a bite out of that instead of seeing how they can further elevate it, which will then further increase the socioeconomic prosperity of these different countries. And the last thing is hiring and talent, right? For 2 years now, we've conducted research to see to size the developer population in Africa. We've seen that there's about 700,000 developers across the African continent. When you think about the number of businesses that there are in Africa, it comes to about 1 developer to 60 businesses, right? If we're saying we're trying to go into a technology age, a digital age, those numbers don't make any sense. And we're also seeing we are seeing conversations around, there's a word called jackpot, or the mass migration and the brain drain. But the thing there is that, again, migration has always been a thing. Historically, it's always been a thing. And people will always move where there's demand, right? Where there's demand for them. But if anything, what we should be looking at is the other side of it, which is more developer training and digital skills and literacy training to enable more people to get into that talent pool.
Folarin, thank you very much. And I just have Dario jump in quickly before we hand on to Karim. Dario, can you hear me? Thank you.
Yeah, I can hear you. Do you want me to comment on what's been said, or are you asking me a specific question?
No. I wanted you to comment.
Look, I couldn't agree more with what Folarin and Zach said. We need to put things in comparison. We need to put in perspective. Not only the VC and tech space is a tiny proportion of the economy, but it's a tiny in proportion with the rest of the world, but it's also a tiny percentage of GDP within the economy. And even though it holds a lot of potential, there's so much groundwork that needs to be done at the level of infrastructure, at the level of training, at the level of talent and capital. And also something that we're realizing more and more is that we cannot keep relying on international volatile and high risk capital, because as soon as there's a tiny shock, not committed capital ends up being more of a liability then. And so creating structures that allow to have both sort of local capital that is more resilient and is dedicated and is there when times get hard, in addition to international capital, is very key. Because the data show that like 60-70% of all the funding that has been raised over the last 15 years using Briter data is actually being raised thanks to capital coming from overseas. And this creates a number of problems. Of course, when companies scale, when companies scale, they attract capital from the outside of the continent, because obviously it's a natural reaction of international investors to scanning companies and opportunities, but there needs to be a balance. This said, there's a lot of work that I am very positive when I see it. It has been done at the talent, at the level of sort of on the ground knowledge that has been developed. A lot of collaboration that are happening between sort of corporates, government, NGOs that maybe previously were focused on sort of 5-year projects, and now they're focused on supporting companies in the long term and private enterprise. But yeah, apology for the sound. I decided to stay in this cafe from a previous meeting because I was afraid I would get stuck in the Wayaki way to go to the office. So apologies for this. I'm trying to keep like my hands on my ears to avoid echo. But please feel free to ask me any other questions.
Okay, thank you, Dario. Karim, over to you.
Thanks, Gbenga. No worries, Dario. I guess you're demonstrating some of the infrastructure challenges that Folarin talked about earlier. But I think Folarin has actually set up a perfect matrix for us to think through the pulse of tech in Africa. You know, the four pillars around finance, markets, policy, and talent. So I'm going to kind of continue to interrogate along those lines, you know, if I may. And my first question really is around finance. And you know, obviously, Folarin, you've demonstrated the big differences between a single country in Europe, the UK, and the whole continent in terms of the amount of funding raised. And I think we all know that. My question is, what impact in 2023 and 2024 do you see happening in relation to funding into Africa from the global challenges facing the tech world, you know, the downswing in prices, a number of the scandals that have been evolving in recent weeks and days. Have you begun as Google to think through what that means for the funding landscape in Africa? And then I'd like Zach and Dario to also jump in with their views after Folarin has expressed his.
Thanks, Karim. I laugh at this question when people ask me. I'd explain why. So I think maybe I break it down. I like to bucket things. So in terms of let me address the scandals first. I think that's the easiest one to address. A lot of
Folarin, just one thing to say before you go in. We also have government amongst the attendees, right? So people from various regulators. So I just wanted to bear that in mind because it's good for them to also get your perspective on this, and they're from a number of different countries as well. Yeah.
Got it. Thanks for that context, Karim. Yeah. So on the scandals, there's my biggest thing with that is that conversation is that nothing that we're seeing here is peculiar to the African continent, right? It's certain things are a function of individual, and certain things are seen in certain in different toxic industries, toxic verticals, especially high growth industries, right? So those can be addressed at a different level. But what I'm going to tie that into what the next thing I say is that investment is not benevolence, right? People invest because they see potential rewards. They're trying to, it's a high risk, high reward society as well. They're trying to 5, 10, 50, 100x, 1,000x their money, right? So regardless of scandals, money will still be pumped into where there's potential reward. That's the shortest part of that. In terms of prediction for, I guess, 2023 and onward, I think over the past couple of months, we've seen a lot of correction. We've seen correction for valuations. We've seen, even if we kicked off very bullish this year in terms of funding, we've seen quite a slowdown with funding as well. And reasons for that are, again, Africa does not exist in its own, in a silo. It exists in the context of the world. And we're seeing economic headwinds globally. So that is also taking a toll. But what we're also seeing with investments, and maybe Zach will speak a little more on this, is that we're seeing what usually happens is rather than the bigger bets, people would rather spread their bets. So it's like smaller ticket sizes, smaller checks, but for more people. Because then it's still a game of, I want to 50, 100x my money. But now I also know that more startups are going to die, pardon me. So if the ones that succeed can make up for the ones that aren't doing so well, then that still works. That still works in my favor. In terms of our own perspective and how we are navigating, is also part of why I'm not in Lagos, Nigeria at the moment, is because I also understand that a lot of the work that we do as Google is signaling for the ecosystem. And I'll speak about two things. As one thing, actually, the Google for Startups Black Founders Fund in Africa, right, where we committed $50,000 to $100,000 of non-equity funding to about 50 startups last year and 60 startups this year. Right. With that, what we've seen is other heavy hitters, other ecosystem players also make commitments to put money, invest in the ecosystem. That was, first of all, that was actually a proof of concept for their own due diligence or for their own observations of the market. But second is for them to also realize that we are seeing the potential and we are signaling for others to also see that potential. And now they are deciding to put money in. So it's going to be very interesting for us to regress from that. So again, going forward, what we're looking at is seeing how we can either remain flat, as a result of the economic headwinds, or even further double down on our investment into the landscape. We see that, again, I like to say that a dollar here, a dollar in Africa is like $100. Sorry, a dollar in the West is like $100 in Africa, right? I guess for reasons whether it's the FX differences or the lack of, the absence of FX, and many other reasons. But for that, every dollar counts out. And the more money we get into the ecosystem, the faster we're able to scale as an ecosystem, not just Nigeria where I am or where I should be anyway. So yeah, I think people have a pessimistic view, but I'm still super optimistic, again, because it's still a high risk, high reward society. Also that where there's a plethora of challenges, opportunity also abounds. So it's still day zero. We're going to see many more solutions being made. We're going to see many more startups being created, and we're going to see much more investment. What we see is that similar to interest rates, we see slowdowns in the West. What we're going to see is that money move to the global South.
Thanks, Folarin. It's super interesting. I'm going to pick up on one of your comments and direct it towards Dario. Your comment that funding isn't benevolent, right? I think that's sort of a really important and in a sense obvious point. But forgive me for being slightly rude, but obviously we know that a young man, I think below 30 in his pajamas, could raise $1 billion whilst playing a video game online, talking to global funders. At least that's what the FT reports, right? And we know that it's very hard to raise money in Africa, right? Let alone $1 billion for a founder under 30. Dario, the key part of what you do is to fill information gaps, right? And I guess to give people a realistic picture about what the opportunities are and how to think about that. Have you seen? Tell us about. You've been in business since 2018, right? Tell us how, from the Bitter Bridges perspective, you've seen the raising finance landscape change, and when will we be in a position to have a young African in his pajamas raise $1 billion, but hopefully do better with it than a more recent example?
Thank you, Karim. Well, I just wanted to say I'm Italian, and the richest gamer and streamer in Italy is this TikToker from Senegal, who is actually the most viewed TikToker in the world, and he's African.
Okay, great.
African Italian.
Yeah.
So there are people who can raise a bunch of money from Africa in pajama. And I actually wanted to say that the gaming, so we focus on tech, but there are some industries from gaming to design to fashion in Africa that are unbelievable and are unbelievably over the last few years. And we tend to kind of forget them because we're focusing on our tech bubble. But like there are other industries that are getting money, and young fashion stylists, young gamers and young game producers that are really now. I actually had a talk recently about my relative optimism on what's happening in Africa. Yes, we might be seeing a slowdown. We've seen the last couple of years being incredibly inflation in terms of funding, but it's something that has been steadily happening over the last 10 years, and it's been the growth of all methods. So the number of companies being founded, the number of companies, or the number of deals being signed, the number of investors entering the space, the number of international investors entering the space, the average ticket size aligning more with the standards. The fact that there are more types of checks that are being written. So I know that Zach has been very vocal about the use of safe and convertible notes. A lot of organizations that have started tinkering with Africa funding with grants, including Google, are now doing equity. And this is the case with many funds, like from Vigor to Catalyst Fund, early stage funds. And these are all trends that have been very positive. I do think we'll be seeing a significant adjustment. But this is due to the fact that as much as now we're considering this as a slowdown, we were not as critical when the spike happened in 2020, 2019 of funding. And there's this chart, I'll probably be publishing it soon, that looks at the last 5-10 years of funding. And if you actually draw a straight line, you can see how the actual weird years have been 2020 and 2021 as opposed to 2022, because 2022 follows exactly the straight line of steady growth of the ecosystem. So I remain positive because of the diversity and the growth in numbers in general. I like to usually gauge the ecosystem by number of deals and activity as opposed to the total funding, because as I said at the beginning, like 5 companies are getting all the funding, and there's always going to be someone who's very successful in fundraising and raising funding, and then skew the ecosystem. But the average ticket size is far lower. But there are people like Zach, and there are more fellow early stage investors that are entering the space. They understand the space, and they're making bets, and they're training entrepreneurs. And finally, something that is very important to also understand is the fact that the wave of capitalized startups in the last 2, 3, 4 years has also led many kind of mid managers and executives to become sort of capitalized enough to start writing angel checks. And this has a massive trickle down effect on the space. And this we're talking about local founders, local team members, not just American white founders or American white employees that are entering themselves into the company. So I remain positive because of these long-term. Obviously, Zach is very bullish. I know about the demographic potential of the continent. I'm very familiar with his slides, so I remain positive. Every time I was just telling yesterday, the cab driver, I was like, in the last 5 years that we come to Nairobi, it keeps getting better. Every year I come to Nairobi, and it keeps getting better. And this is the case for many other African cities that I've been continuing to grow up across the continent. So I think these are my 2 cents. I remain positive. I think shocks are there, and shocks have always been there for the markets. And just like because the African startup ecosystem is young, we shouldn't think that shocks are eternal. We need to adjust it back and re-strategize. But for people who are here for the long term, I don't think anyone is being too worried.
Thanks very much, Dario. Just to remind everyone, we have one question in the chat already. Please keep your questions coming, and Gbenga and I will get to them. We're also trying to cover as much ground as possible. So, Zach, if I could ask you for your final comments on the sort of access to money bits, and then I'll pass it on to Gbenga, who wants to move on to social impact.
Yeah, I mean, just access to money, I think I covered this in one of my earlier points, but the reality is one of the biggest gaping holes in the access to capital bit is, so we've seen plenty of money from DFIs into the VC space. I was on a panel at the Africa FinTech Summit a couple of weeks ago in Cape Town, and although the numbers aren't official, if you were to estimate the amount of money that DFIs invest directly or indirectly into tech startups in Africa, it's probably between 80 and 90%. So a lot of the DFIs, I mean, I'm assuming folks in the audience know who the major DFIs are, but it's pretty much European and American developmental finance institutions that are funded by taxpayers that started off as a way to sort of give development aid, and then eventually transitioned into being direct investments, and then as LPs and funds. So if you look at the likes of the CDCs now, BII, FMO, Proparco, IFC, AFDB, all the 3-letter acronyms that you can think of, Sweat Fund, or Fund, etc. Directly or indirectly, it accounts for almost 80 to 90% of capital going into venture funders. Now, if you look at that stat in the US, in North America or Europe, that number is, what is it, single digits, not even, I would call it NA, not applicable. So, you know, and you think, okay, what strategic value are DFIs adding to founders? There is some value, of course there is. But ultimately, if you look at this, the top performing VC funds in the US, the top performing VC funds in Western Europe and in Asia, it's really strategic LPs, individuals, family offices with connections to industry. that can add a lot more value than just capital. A big missing part in Africa is that. So you don't have a lot of strategic retail LPs, and we're also missing CVCs, corporate VCs, right? Africa has a massive opportunity for corporates. So it's specifically insurance companies, retailers, banks, telcos that just aren't doing enough from a CVC perspective.
Right.
And I have no qualms in calling them out, not by name, but you know who you are. There's just not enough that goes into it. We have a couple of CVCs on our cap table, and ironically, they're not Africa-based corporates. So we have some very prominent US and European corporates that have off-balance sheet CVCs. Very important point here for the folks that understand structuring and law. When you invest as a corporate off your own balance sheet or on balance sheet, it's very hard to make risk-adjusted investment decisions because you're essentially using your capital as leverage. So for those of you that understand, capital adequacy ratios, I mean, to invest $1 into a technology startup for a minority stake, you need to show $4 in equity reserves, which is a nightmare just from an accounting perspective for large corporates, right? So CVCs need to be done off balance sheet where the corporate becomes an LP in the fund through an SPV. You don't have that level of sophistication in a lot of African corporates, sadly. The ones that do exceptionally well, but it's too little. So I would argue that the biggest gap in funding from a capital perspective into seed, Series A, Series B, Series C stage African tech startups is from CVCs. That can single-handedly solve the entire challenge that we have in Africa. But there just isn't enough appetite, enough understanding more than anything else. And there's a huge part that, our industrial families in Africa need to play. So all the money sitting, I mean, you guys are sitting in Kenya. What are the industrial families in Kenya investing outside of property? Not much,
Well, I guess that I'll challenge Dario, right? Because that's where Dario's business can help provide the data and the information. I think your point about CVCs is great. And I think your point about having off-balance sheet structures is also very interesting. So for the companies on the line, it's a real shout out to start thinking differently. And Dario, I guess you need to empower these companies and these families, as you say, right? To move away from bricks and mortar and so on and so forth, and into this. And the more success stories that you can demonstrate, I guess, the easier it is to make that case. So with that, I'll pass on to back to Gbenga. Only just pointing out, Gbenga, there are questions also in the Q&A. So I leave it to you as to how you want to deal with those as well.
Karim, I think we'll just take a couple more questions and then we'll do the Q&As as we get closer to the end.
Okay, great.
But the question is on my side is around impact. So impact is important. I tend to think that in my spare time, I spend a good amount of time looking at investments, looking at potential startups that are growing around the continent. And one of the things that I know, whether it's healthcare, education, agriculture, or even FinTech, is that impact is particularly important around us, and that may just be because of the infrastructure gaps that we see. And so my question to the panel is, how important is impact? When you're looking at a startup, and what do you look at in terms of, it's easy to say that sometimes FinTech is all about financial inclusion, particularly when we're dealing in, for instance, cash in, cash out startups in Nigeria, where it's people at the bottom of the pyramid who don't have access to bank accounts or brick and mortar banks that are the target of some of these startups. And so I was just wondering if you guys could speak to how important social impact is when you're looking at an opportunity. And I'll go to Folarin first on this one.
Thanks for the question, Gbenga. We 100% look at impacts, so social impacts, when we're assessing and selecting startups for our programs, and again, alignments to the SDGs. But it's actually one of the easier things to look out for in the landscape that we have due to the plethora of challenges that we have. So almost, unless it's maybe a betting company or a certain kind of company, right, they're very likely to solve for challenges that are pressing to, I guess, the society, right? And there's a quote that I like, there's a quote I like to talk about. I'm going to go away from FinTech a bit. And it goes like this: of all the inventions, the alphabet and the printing accepted, those inventions which at bridge distance have done the most for civilization of a species. What that essentially means is that for every time we're able to save, in every moment where we're able to save people time, right, that time is converted to further technological advancement, right? And what that looks like in the tech landscape for us, or has looked like for us, is that, again, for us, we assess, okay, number of jobs created, number of direct jobs created, because that's what is trackable, right? But what you see with these things is that for every time a person is granted access to finance or funding or to further market, what happens is, besides the direct jobs that they're creating, so there's a trickle-on effect to the number of indirect jobs, to the number of indirect jobs being created by the people that they're hiring, to the amount of wealth being further going into the rural areas, right? To the amount of resources, well, to the amount of technology going into those areas as well, to the amount of sensitization and education as well that's going into those areas. It's really these are some of the things that are very hard to track and measure in terms of social impact, but they're happening as well, is my biggest thing. We look at things like, in terms of metrics, I think like any other, we look at things like, okay, maybe besides the jobs created, we look at things like the revenue generated as well, and the follow-on funding raised. And the reasons for that are, so for the follow-on funding especially, again, especially seeing how Zach even mentioned, is that most of the funding comes from outside. Zach and Dario mentioned, most of the funding comes from outside of Africa. So what happens is, that is money that we had never had access to, or they would never have had access to. And that, even if it seems like it's a lump sum, when it's broken down into salaries, it's broken down into, it's passed on into other facets of life. And these things also aid, I guess, socioeconomic improvement and prosperity, right? And on the other hand, for the revenue as well, what happens is, when you sort of slightly shift the needle and you pay people higher than the current cost of living, what happens is, these things, they are shifted into, I guess, closer to the middle class, if anything, or the lower middle class, or the middle, upper middle. And what happens there is, they're also able to further employ, further empower other people. I think generally for impact, because of the number of challenges we have, right, where it's going to be very hard for us to not solve for them, right? We see, for example, I think, so Karim mentioned how someone raised funding in his pajamas, playing video games or whatever. And we see that, I give examples, right? For fundraising, I've been on different demo days in other countries out of Africa where people are pitching for, and don't get me wrong, these are problems that they're also important to solve, but they are particular to their own mature market. So you see things like plant moms, solving for plant moms, right? Or pet moms and pet parents. We see things solving for those things. Or like, and those, again, those are challenges that they need solving for, and there's a need, right? That's why they're solving for it. But at the same time, when you bring it back home and look at, we're trying to improve financial inclusion for X number of people, that is the social impact is invaluable, is immeasurable, right? Regardless of the vertical, whether it's health tech, taking more social workers to the rural areas, giving people access. So again, I think it's one of the easiest things for us to solve for. I think that's my short/long answer to this. We don't need to think too much. I think we'll still be very deliberate and intentional, don't get me wrong. But if you look at just the microeconomics of this, it's always going to be socially impactful to not just Nigeria, but most of the African continent. Just more funding, more jobs being created.
Thank you, Folarin. I was wondering if Dario or Zach want to jump in on that.
Look, I'll jump in very quickly, probably to reiterate what was said. Sorry, Zach, I think there was a little lagging. But I'll be very quick. As Folarin was saying, like, I like to look at things in perspective. We all working because there's been significant impact of like all these operations activity initiative at the border level in society. So there's definitely a bigger conversation to be had on the role of tech and on the role of, I always call it the PR effect of tech and VC in Africa, right? Because at the very least, Briter was founded with the idea to promote a brighter narrative around these markets, right? And if we look at what at the very least what startups and VCs are doing in Africa is turning Africa into an appealing investable destination. So there's a narrative shift that is happening, and I've been very much pushing this idea. That's what you're seeing now. So people will be like, "Oh wow, lots of entrepreneurship, a lot of cool ideas, a lot of ways like innovation and innovative business model and technology that we use to solve problems." One of the probably most common sentences you'll ever hear in this space is, "We like African entrepreneurs because they are solving real problems versus other entrepreneurs," and which I don't necessarily think is true. You can find some random companies from down the continent as well. This is simple. Exactly.
Dario, we are struggling to hear you now. We are struggling to hear you.
I could see that your faces were slowing down on my screen, but I'll pass it over to Zach.
Okay, Zach.
Yeah, listen, I don't want to spend too much time on this topic because we've got a few questions in the chat, but I just wanted to say very clearly on the impact thing. I've had this question for the last 10 years living in Africa. I think let's just call a spade and make sure that I strongly believe that if you can create commercial traction out of the ventures that you build, the impact, and I say this out repeatedly, either intentional or unintentional, is significantly higher than any specific impact of venture. Not that I'm trying to tout our own fund here, but our fund has created more than 1,000 sustainable jobs in the last 2 years across our ventures. I can't think of a single foundation or a nonprofit that has created that many jobs in such a short period of time. So I'll rest my case there.
So Zach, I think I would just come back on one point there, and it was the point you made earlier about when the blend of funding is so DFI focused, right? The lens inevitably is intentional around impact, right? And obviously, if you succeed in your ambition of changing the blend of funding away from or to reduce the importance of DFIs, then obviously you get a different outcome on that question. So I just thought I'd mention that that point.
Yep. Fair enough. Thanks. Yep.
Karim, do you want to take another round of questions and the questions?
Sure. So what we'll do, there are questions in the chat. We'll leave those for now. We'll come to them. I want to move on to the whole kind of policy part, right? Folarin, you mentioned the startup bill and the startup act in Nigeria and so on. I know that a number of our clients struggle with inconsistent regulation, with how can I put it? Well, if we can't license you because we don't know what you're doing, we'll make up a license. And until we make up the license, you can't do what you want to do, right? Kind of approach in a number of markets and so on. But on the other hand, we know there are lots of tons of examples. And then you've got obviously some founders who say, well, look, we'll wing it, right? We'll make the market and then see what the regulators have to say. And we know that sometimes that works and sometimes that doesn't work. And there are examples on both sides of that equation. I don't want to use any names, but we know there are examples on both of those sort of sides of the ledger. I just wonder, and obviously Google has amazing convening power, right? That's the one thing that more than anything, you have that convening power, right? I just wondering what efforts you're making in that space around helping regulators and governments think about regulation appropriate for the tech landscape in Africa.
Thanks, Karim. It's really impossible to build, and outside of the lens of policy as a tech startup, as a business in general, it's really impossible to build as outside of that lens. Just as at the start of the pandemic, we saw a policy in Lagos State in Nigeria shut down 3 businesses. One of those businesses had just raised millions in funding, right? So again, I think funding plays a critical role. And in terms of what we do, what you don't get to hear in the news is how we bring together roundtables to hear about what our startups are facing and how we can support. What you don't hear about is that we also we contributed to the Nigeria Startup Act, now an act. We contributed to the formation and development of that act, right? And we do this in not just only the countries that we're currently present in Africa, which are Kenya, Nigeria, South Africa, and Ghana, but also in other P1 markets that we're also looking to enter. Because again, a rising tide lifts all boats. So even if, yes, we're trying to support the startups that are there right now, we know that it would also favor us when we decide to go into those markets. So what we're doing is we put aside budget to actively and proactively engage with policymakers in terms of just sharing on 2 fronts. On one hand, guiding, advising, consulting on things like policy formation or policy removal, policy correction on one hand, but also creating visibility around the impact of the work and the relevance of the work that is being done in the startup and developer ecosystem. What that looks like is frequent sit-downs with these policymakers. What that looks like is newsletters, written letters, in fact, to these policymakers as well, and much more. It's ultimately certain things are driven by economic decision, or I guess a personal decision. So there's only so much you can do. But I guess as a company, again, not just in Africa, globally, we'll continue to, I guess, advocate for startups and developers. But the last part I'd say there is that there's only so much that we can do, right? And for my team, for example, I lead the startup ecosystem. So part of my responsibility is also conveying impact numbers, impact metrics, and the relevance of the startup ecosystems to the policymakers. Right? But there's only so much I can do. There's only so much I can know as one person or as my team. So what I usually do is try and call on startups. So I'm very accessible. So reach out to me, let me know what is happening, right? And let me know what you need support with, right? If you've got a whiff of something, let us know so that we can also further support you, or we can point you to people that will support you, or point people that can actually also influential to also engage with the policymakers for change to be made, right? Yeah.
That's a really great shout out, Folarin, and I'm sure there are about 100 people online who you're going to get emails from momentarily. So I don't know whether Zach and Dario have anything to quickly add, but quite quickly on what Folarin just said. No, good.
From my end.
Okay, so look, we have 4. I'm just conscious of time. We have 4 questions and comments in the chat. The first is from Serena Davis. I'll just read it out. On the continent, break-even requirements 1 year seem to be very different than Europe and USA 3 years. How does this affect estimating the true potential of the continent, especially in creating comparative KPI? Zach, do you want to take a stab at that comment in question?
Yeah, I don't know where the commenter on break even or where that assumption comes from. I mean, if you're a real venture investor, you understand very accurately that no one's expecting you to be cash flow positive or break even if you have true venture style growth metrics. Don't put a gun to my head and say you need to be break even by year 2 or year 4, year 5. I think it's stage appropriate. I would say as a general rule of thumb, once you are preparing for a series B for Bravo raise, people expect you to be as close as possible to break even. That being said, break evens mean different thing in different industries. If you're an insurtech, you definitely don't have as much leeway to getting to break even as a digital bank, for example, right? Digital banks typically break even significantly later. I mean, look at companies like Monzo and Nubank, and in 26 they took years to break even. Some of them are still not break even. But it's and this is the problem we have in the industry is you can't apply a one size fits all solution for everyone. You can't have generic investors saying, hey, I'm doing VC. I expect a digital bank and an insurtech and an agri-tech to all have the same growth trajectory. No, and also valuations are, it's horses for courses. The way you value a digital bank and the way you value an e-commerce company and the way you value a retail tech like a Market Force are very different. And people don't, unfortunately, take the time to understand what metrics are relevant for what startup. So, a question like that gets asked a lot in panels, and I would strongly recommend attendees of these panels to do research on what metrics are relevant. So you can't say a blanket statement like, oh, you need to get break even in 1 year. Who said that? No. Sorry, I'm being very blunt, but that's my personality.
No, that's fine. That's why you're on the panel.
Need to be relevant for a particular industry. So no, there is no hard and fast requirement that if you're an African startup, you have to break even in 1 year. Whoever mentioned that must be, I don't know, off the charts. I don't know.
Okay, so I want to just move on to a second comment in the chat, which I think is a really interesting one, actually. As we imagine the future of the tech ecosystem in Africa, what would be a healthy mix of adopting existing tech and innovating our own homegrown tech? Right now, I say that's a very interesting question because even in the work we do, we see lots of companies kind of creating their own tech. And then when it comes to diligence, some of the VCs say, well, actually, guys, we think this better tech exists elsewhere. You're fixing a problem, but why did you try to do this yourself? Why didn't you just buy in more of what you've just tried to build, right? Folarin, can you take a stab? I mean, I would imagine, because you obviously Google has a bunch of products right out there. Can you just take a stab at that issue?
I was actually going to throw it to Dario. I mean, I don't think there's a sweet spot for, I guess, a mix of adopting foreign tech and building locally. I generally come from the point of view of, I don't see the need to reinvent the wheel, right, for anything, right? If the knowledge already exists.
I guess, Folarin, sorry, just to press you a little bit, do you see more specifically, and this will be good for the founders and the startups in the room, do you see too much reinvention happening? And Zach as well, that's to you too. Do you see too much reinvention? Folarin, maybe you can take that first.
So I have a mixed response to that, so yes and no. So I see replication of things that have been built in other places here. And I think on one hand, I can say, okay, that is fine because it doesn't exist and there's a market to take advantage, to capitalize on for them. So I say maybe, yes, there is a lot of replication or reinvention, yes, but also no, because it's still a bandwagon mentality. It's still, we're solving for the same problems, right? So there's still so much room for innovation into many other verticals, the full value chain of different verticals. It's a yes and no for me.
Okay, Zach, from you?
Yeah, I think the question needs to be a bit nuanced here. So I think if you are solving a problem that is very, can you guys hear me?
Yeah.
If you guys are solving a problem that's very specific to the African continent, and this is why I enjoy having panelists like Folarin and Gbenga and Dario and everyone else here that understands this ecosystem. Certain industries have very unique African flavors to it. So, for example, if you look at within the payments landscape, this concept of agency banking only exists in Africa, right? You don't have it anywhere else in the world, right? Because people here know that companies like Dot Bank in Nigeria, Opay, they work on agents. M-Pesa was built on an agent network, right? So you can't compare that to any other comparable fintech in the US or Europe or Asia. So therefore, you have to build tech that works in that industry. So that
okay. So Zach, I'm going to jump in there because time is pressing. I get the point, and I think it's an important one you make, which is that we have very unique problems to solve.
It's for certain things, like
for certain things. No, I get it.
One, but not for everything, right? If you're doing offline to online USSD versus mobile, that needs to be built in-house for the African content. But if you're building an e-commerce platform or if you're building a payment gateway, you don't need to create your own tech. You can use third-party software. So it's again, horses for courses. I'm just giving real examples versus being generic.
Got it. So look, we have like a minute and a half, and so I'm going to end with 30 seconds, and I'll pass it to Gbenga. I think one of the things we didn't get around to talent, right? And Folarin shared a great data point about 1 to 60 businesses in terms of ratio of developers to businesses in Africa. One of the things we're hearing a lot about is how big tech is in a way almost worsening that issue, and migration is causing lots of talented Africans to leave. Folarin, this is more. I'm just provoking the bear a little bit. You don't have time to respond to this one, but it is evidently something that the continent needs to deal with, right? We need to keep more people on the continent, or at least working for the continent. And so, in a sense, it doesn't really matter where they are, right? They can be in Africa, they can be elsewhere if they're working for the continent. Gbenga, I'll pass it to you to wrap up, and I'll just say thanks to all the panelists and all the attendees.
Karim, thank you. Look, the panel, we were meant to be talking about the pulse of tech on the continent. I think, we've tried as hard as possible to do the deep dive, but in the time hasn't been on our side. But I think it's important that we've been able to touch on all the major. We've been able to touch on all the major issues that you would think about. Regulatory behavior, the funding gaps, the skills gap, the infrastructure gap, and I think at least we've hit all of these issues, and it's food for thought for all of us. Just to wrap up, really just to talk about ALN and what we bring to the table, the fact that the ALN network across the continent includes firms that are spending a significant amount of their time around tech, and that's why we're having this session. I think it's also important to just say that we're also very dedicated to making premium legal services available to startups on the continent, and that we do have a tech agenda that's essentially out there, making sure that we are constantly talking to founders, constantly pushing the envelope around regulatory behavior. And to one last thing that, and I think it was Karim that made the point. Look, it's clear to all of us that the continent still has a way to go. I'm not going to around skills gap, and wherever the Africans are that are working, whether they are physically on the continent or living in Canada, I think it's important that we're bringing all the skills to play in developing tech on the continent. So I'm sure, ladies and gentlemen, that you will, and to everybody that's listening, that Folarin, Dario, and Zach have essentially over the last hour brought their experience to bear on the subject matter. There's still a lot to ask and a lot to talk about. It's a never-ending conversation. You know, there was a write-up yesterday in the Nigerian newspapers about how the central bank must have been right. They told us that we shouldn't do crypto. And in the middle of all of that is the truth. What we want is regulation as opposed to saying, no, don't do it. And FTX doesn't make it right when there's no regulation in the landscape. So on that note, I would just like to say thank you very much to the audience. Thank you to the panel. And I'm sure these conversations will continue. Thank you, guys.
Thanks so much, Gbenga. It's my pleasure now to thank you, Folarin, Dario, Zach. Much appreciated. I hope you stay on for the remaining panel. I'll pass on to my partner, Dominic Rebelo, who actually heads our tech practice for a much deeper dive into the regulatory environment, current trends and development in tech and fintech on the regulatory side. So over to all of you. Over to you, Dom. Thanks very much.
Good afternoon, everybody. I hope you can all hear me. I can see from me you've got your video on. If I could ask Mandeep, Sheena, if you guys could put your videos on if possible and unmute.
Hi there.
Afternoon to you all. Thank you for joining us.
Afternoon.
This is our second panel, our regulatory overview. I'll just give a very quick introduction to my three panelists. I've got Sheena, who's a director at the UK Kenya Tech Hub. Significant experience in both legal financial services and impact investing across Europe and Africa. She's also employed with the Digital, Cultural, Media and Sports Department with the British government in Kenya. So a very diverse background there. And also a proud failed entrepreneur, which I'm sure she will tell us about as we get into the discussion. Secondly, I've got Funmi. Funmi is one of my partners in ALN Nigeria. She works in their banking and finance team and a lot of experience in TMT, venture financing and traditional banking and financing and tech. So she brings the West African part of the continent across to us. And thirdly, Mandeep. Mandeep is head of business development at Input Output Global, one of the world's preeminent blockchain infrastructure research and engineering companies. A lot of experience in IT, mobile telecommunications, and obviously emerging financial technology space. And myself, I'm Dominic Rebelo, partner at ALN Kenya. I run our corporate team and head up our tech, both our tech practice and our tech internally at the firm. So just to set a bit of background, earlier this year, you may have seen the Tony Blair Institute for Change. They put out a global paper on what's needed to supercharge Africa's startups. They identified three main challenges: a lack of funding, improving the business environment, and strengthening support networks. Now, lack of funding, we're going to look at in quite a lot of detail on day 3. We've got a panel covering early stage growth and then IPO and exits with speakers in all of those. We're looking at improving business environment and strengthening the support networks. Both of those are really based on the regulatory environment. You're not going to have a strong support network unless you have a good business environment, and you're not going to have a good business environment unless you have a strong regulatory environment. So that lack of clear regulation, overburdening companies with compliance, a lack of legal and fiscal certainty, and a lack of networks where information could be shared, all inhibit African startups from scaling as fast as they really should. Ultimately, Africa is a high-risk environment when you compare it to more developed economies. There's significant information asymmetry, lack of credit information, volatile exchange rates, and like we said, fragmented and often restricted regulation. So really, what is the right level of regulation, I guess, is the million-dollar question. Tomorrow, we'll delve into specific sectors more deeply. We've got panels on FinTech, Health Tech, InsurTech, and General Tech, where we'll look at the regulatory environment across the continent in each of those. But for today, it's really a kind of overview of what is the level of tech that is correct. Should it be regional? Should it be domestic, individual countries? Are sandboxes correct, etc.? So maybe to start, maybe to kick it off, from all this cumbersome regulatory and the hurdles that we see across the continent, I don't know, Sheena, you've obviously been across the continent working in different jurisdictions. Should there be a one size fits all? Should we be looking at this from a domestic perspective, individual countries, or should we be looking at it from a regional perspective? What are your thoughts?
Yeah, no, great question. And just before I answer that, can I just say, the things that you mentioned in terms of access to capital are also kind of directly linked to the regulatory environment. So to give you an example, one of the projects we've done at Tech Hub was, can we get more local angel investor networks going? And so we started training angel investors, meaning high net worth, not even high net worth, professional people to kind of invest in local startups. And we did it in Kenya, South Africa, Nigeria, and the UK. And weirdly, just to give an example, out of that training, one group was formed called NIBAN, which is an Arabic Business Angels Networks group. And in 1 year, they made 11 deals with $400,000 worth of capital leverage. 3 of those startups went and raised 1.5 million. Now, we're trying to scale that. And one of the things that keeps coming up is, especially with our UK investors, is like, well, when I invest in a UK-based company, I get, through SEIS and EIS regulations, you get tax reforms, you get you get a lot of support from the government, which really stimulated the UK startup economy. So a lot of the times, regulation can actually also be that catalyst to get local capital in the market or help with the talent, etc. So again, we're running a program on talent. And part of that is a lot of work with the government of Kenya directly. At the moment, I'm focused on Kenya through the UK Kenya Tech Hub, but obviously I've worked previously. Similarly, with general business regulation, you touched upon that as well. So we launched a business regulatory toolkit, which basically focusing on 10 counties, which is like an online calculator, which tells you, how much do things cost, what are the cost of licenses, how long does it take, and things like that to really help businesses when they're starting, launching, and scaling. So I think I like exactly what you said about the regulatory environment, but I think not only sometimes we just think of it as like this hindrance but it can really be done well, can be really, really catalytic. And I think the bit there is what focuses on your question, done well, and what does that mean? And I think just to go back to your question, I think, so should we have individuals, should we have countries, should it be sort of more regional? I mean, ideally, wouldn't it be great for the Africa free trade continental environment where we had like one market, we had like one regulation, where and a regulatory framework which would apply? How much easier would that make it for startups to kind of expand? The truth is, it's really more complicated. And if we even look at like regional blocks, like the East African bloc, South African, West African, and it's really, really complicated because context matters. So, for example, and I'll come back to Kenya. In Kenya, I think we have about 120 regulators in Kenya, which is a bit insane if you really think about it. And when we've done this project where we've gone and chatted to the regulators, sometimes the regulators themselves are really, really struggling because, they're broke so sometimes they see their function as a way to kind of get revenue. And that's really not the function of what a regulator should be. A well-funded regulator is actually about having the market grow. So I think ideally would love to see kind of an Africa-wide approach and building up on global issues, right? So for example, with pure tech matters, right? Like things like AI. I think you have to have global governance standards. So, and by global, I'll be very clear. I don't just mean the North. I don't mean the global North. I mean the global South. And I think it's very important to have Asian, Indian, Chinese, Japanese, African voices in that AI conversation, because when we're looking at AI and data, which I think is going to be the next, we need to regulate that right. That has to be a global conversation. But there's certain things which I think, so for example, the UK startup funding, angel investing, that can be quite local. I think the earlier panel touched on all the startup bills. We've seen, Nigeria, so in Africa, Nigeria, South Africa, Kenya, Nigeria's done theirs, but the startup bill was proposed some time ago here in Kenya as well. So I think my answer would be pick good bits from places and then try and create something that works, and then move on to try and do a regional or a block approach, because it's hard. And I think you can have the best intentions, but I like the pilot approach. Try something that works and then scale it, rather than trying to be really, really big up front and actually just not taking off, which I think is generally what happens when we try to be super ambitious.
Thanks, Sheena. Maybe broadening that out, because East Africa, we have the East African community, but we don't have single regulators, etc. But if you look across to West Africa with the HADA and the changes there we have 17 countries, if I remember right, with unified laws across various sectors, company laws, banking and finance laws, and more move towards a single regulator across the region. Now, I don't know if either you or Mandeep has any experience of West Africa and the HADA region, and if you think that is the way to go. I mean, you've got to put that against kind of the global context and Brexit, etc. European, the EU not being as strong as it used to be. Is it the right way to go, or should it just be left to domestic individual regulators to regulate what is a fast-growing tech space?
I'll let Sheena respond to that one, because I'm not too familiar with the West African regulatory environment.
Yeah, sure. Thanks. So I think, so I really like what they have done in West Africa, and I think there are some really good lessons. But having said that, sometimes, so like when I speak, and this is from the startup experience, not so much from the regulatory side. I think a lot of the stuff I've spoken to have said, and again, this is just direct quotes from startups. Nigeria is a nightmare. And yet, if I think about it, the Nigerian market, in terms of the size, in terms of what's happening, is probably one of, I think if you could make it in Nigeria, you're kind of laughing. So the question then becomes, I think in theory, yes, that would be a really, really good approach, but I think in practice it's really difficult. So right now, if I think about it, most startups are, in terms of where do we register, where do we set up, where do we grow? Rwanda comes up as one of the places for ease of doing business. But remember, it's not just about ease of doing business. It also depends on kind of market size, business environment, and other factors. So I think, so I think in theory, my answer is yes. I think that is a really good approach, but I think it's really difficult in practice. And what I think would work is to do sort of what we've been trying and it's not succeeded so far, is sort of the Eastern Bloc, the Western, North and South, and then trying and seeing, can we actually do this in East Africa? And I think there've been attempts to try. So as part of the East Africa business community, the government, they set up the whole department, and I think there've been lots of conversations around it. And I think there was a roundtable where we try to gather some of the regulators. I don't know if you're familiar with the IRA Bima Lab program. So that's the Insurance Regulatory Authority here in Kenya. And we worked with them as UK Kenya Tech Hub to start this kind of InsurTech Bima Lab, which was basically like, how do you help InsurTechs? And part of that was early stage support and then moving them to a sandbox kind of environment. And I think about 2 or 3 firms did get into it. And as phase 2, Bima Lab has now expanded to Tanzania, Uganda, Rwanda. So basically the IRA in Kenya tried something, and now they're working on sharing their learnings with the other, regulators, insurance regulators. This is very limited to insurance though, in that space, and now they're kind of working to sort of standardize, etc. It's taken long. I'd say it's been a year and a half, and we've had some good learnings, but some good challenges. I think what helped there was, again, IRA, strong kind of regulatory government support, but also it was through FSD Africa. So again, FSD Africa has these links around the different kind of African countries, and though we limited it to East Africa, the idea, the aim is to spread it more. I don't think I've answered it fully, but I think I'll stop there.
Yeah, I don't know from if you have any thoughts on the West African side on that and that regional perspective.
Yes, I do. And so, well, I mean, I agree broadly with Sheena that it's probably a good idea in theory. But no, I think in practice that there will be significant challenges because of the size of the markets. So that within Africa, there are varying markets and with varying sizes, different peculiarities. So I don't think that having uniform laws, right, is the way to go. I mean, what I think would probably be better is establishing standards. And so saying that these are benchmarks that we think each jurisdiction should, focus on in terms of regulation. But I think that's better than, just like having, one standard. And I think Sheena had made the point that theory, yes, but when you now get down to it, the different markets and different peculiarities could then cause implementation concerns. But just in terms of regulation, because, we've talked about how regulation is more of a hindrance than a help. I think I just like to balance it out without holding brief for any regulator, but just to highlight the concerns. So obviously, I mean, we've all talked about how Nigeria is not Nigeria, Africa generally has like major issues with information and all of that. Like a lot of emerging markets and all of that, right? And if you don't have regulators, right, who can step in and maintain stability, protect consumer information and funds, then, I mean, you can't just let things just run wild, right? And so I think that while we understand definitely that there are significant challenges just in terms of all the barriers that affect funding, that create a lot of uncertainty and all of that, there's still a need for balance, right? And both concerns are equally important. I think what AFTA can maybe do, like, and I know right now they're negotiating the e-commerce protocol, is that we can really establish just standards and then best practice type standards that we expect to see rather than firm regulation across board.
Yeah, and maybe if we take this down the other way. So Sheena, something you said about the number of regulators in Kenya, for example. I think that's a very valid point. I mean, maybe we're getting it wrong by looking at a regional level, and maybe we should be starting in the position that jurisdictions should have a consolidated regulator. So, for example, if you look at all the East African jurisdictions, we have a capital markets authority, we have a central bank, we have an insurance regulator. We don't have a single financial services authority which regulates all these different industries, and maybe that's what we should be moving towards. Because when you look at sandboxes, and sandboxes, they've been around for a decade now, but there's only a handful across the continent. And you'll find in some jurisdictions, for example, your capital markets authority will have a sandbox, but your banking regulator, your central bank, will not. So if you're a FinTech and you fall kind of in between the two, you could potentially go into the CMA sandbox. But if you fall squarely under the CBK or the central bank, then you're stuck because you don't have a sandbox to go into. So maybe what we should be looking at is consolidating regulators with single sandboxes, regardless of what tech what novel tech you're bringing in. So whether you are in FinTech, InsurTech, etc., you just go into a single sandbox. I don't know, Sheena, do you think that's an approach that could work?
So I think building on that, what I think the biggest problem is there's too many silos. So if you're a startup, like you're in InsurTech, you are also still you will fall under different regulators, depending including that data protection office now, etc. So you could even be covered by one regulator and you still might fall foul of the other, and you might not even know it, even though you've tried, etc. So I think what we really, really need is a coordinated approach within the regulators. And I think that's from a cultural shift, right? Regulators are not, right now, a lot of the times, and I do feel sorry for the regulators, right? They do, for them, licensing and this and that. It is genuine, and I've heard this, revenue collection as well, because that's what they need to do. But what is the purpose of a regulator? And I think that we need to start with that. What is the purpose of a regulator? And then because without that, a joint sandbox would not work, because we live in too siloed a country where everybody kind of is doing their thing in little boxes, but it's actually really, really hard hard to collaborate. Everybody talks about collaboration, but it's very hard because at the end of the day, you have your own government department that you want to showcase to. You want to showcase yourself to the media, to the public, etc. So whether you're fighting for funding from the government or other donor partners, whether you're fighting for attention, whether you're fighting for whatever it is, you're all competing. So I think before you do a joint sandbox, I think first of all you have to understand, where are the win-wins? What can you identify? Where different regulators can come together and where it's a win for them before doing that. So I think FCA in the UK does this quite well in terms of the sandboxes. And we actually had, again, we tried to link up some of the people from FCA to some of the regulators in Kenya and East Africa, again, to see what can we do together. And it went really well. We had a couple of really good roundtable discussions, but moving forward was very, very difficult. And I think that's where you kind of need to get that buy-in from people to really understand, well, this is what I'm going to gain. And there has to be a win for everyone. And that then goes back to entrepreneurs as well. So a lot of the times, if you speak to the entrepreneurs, the attitude is, I'm just going to remain underground, build, stock mode. I'm not really going to engage until I'm big enough to, afford an ALN lawyer or whatever, and then I'll deal with it. But actually, even with startups, they need to start thinking about it as, start engaging with the regulator, which is quite a scary thing to do. And I know at the moment, if you think about it, like what's happening with the Excise Act, the finance, the 30% turnover on digital lenders. So although, in Kenya now, we're seeing a little bit more organizations. So you have the Digital Lenders Association of Kenya, the FinTech Association, and so they're gathering together and they're speaking to the regulators and they're inputting. But generally, startups don't do that, or even businesses don't do that, right? Like the attitude here is let's remain under, which means both sides don't really communicate with each other. So I think we need to see a lot more, to have successful sandboxes, we need to see a lot more kind of public participation. And actually before sandboxes, sorry, I feel like I'm talking too much, but my last point, before sandboxes, I think what we need more of is policy labs. So for example, if you're a regulator, let's have a policy lab. So we do lots of hackathons, right? So what's a policy lab? It's kind of similar where you identify, this is my issue, and then bring different stakeholders, bring the startups, bring students, bring lawyers, bring people from government, bring people from counties, bring SMEs together, because then you get a broader picture. And then when you're designing the regulation, you're kind of co-creating and you're understanding it. Because after it's reached a certain point, yes, people ask for you also get to set up in the process. So I think we need a lot more kind of that co-creation from the beginning if we're going to see more impact. And this space moves too fast. So we really need to think through agile governance. And I think that's the big thing. If that's the approach. If we really want to see some more successful sandboxes.
No, absolutely. And I think that ties quite nicely back to that point on building support networks and there being a lack of support networks for investors and tech startups across the continent. And I know, Mandeep, there's an area here which you're really an expert in, because we have all of these different startups all operating in tech, but there are some common themes between them. The main one being things like KYC. Everybody wants to onboard their customers. Everybody is doing their own KYC on those customers. So every app I join on my phone, I'm going through a KYC process again and again and again. Now, surely building some kind of support network where that KYC information is jointly put together, held in a single database, etc., and makes it a seamless integration and a seamless joining experience would help all tech startups to grow quicker. I don't know, Mandeep, what your thoughts on that are.
Absolutely. In fact, I'm glad you raised that point, because earlier today and yesterday, I've been in discussions with insurance companies, as well as a major global bank that has operations in Africa. And they're all interested in simplifying the process. So I do agree with Sheena's comments that, I think regulators need to work together, because there are different areas within in terms of what startups are doing and enterprises are doing. And some of these companies that I've been speaking to, they are paying enormous amounts for KYC, because in the fintech world, which includes the insurance companies and micro lenders, they all need to perform KYC. And KYC in Africa is siloed. There are different APIs that connect to different government databases, and it's challenging to have to do that, and it takes a really long time. If all of this was centralized by the governments and all the respective ministries, and all the data was verified and brought into public ledger blockchain technology, it will not only make revenues for the government, but it will bring down the cost of verification for any enterprise, be it a lender, be it an insurance company. And over and above that, and recently, I've lived in Kenya many years. Recently, there's been regulations around the lending, and the credit scoring, for example. Can you imagine how much difference it would make if all of that data, non-PII data, was all on blockchain, and a bank can onboard a customer doing a check on blockchain for the identities KYC with the identity providing consent. The micro lender can give a loan to that same person and spend a much lower percentage in terms of KYC fees using the same blockchain network. Here at Input Output Global, we are actually talking to governments for something that we've developed, which is a decentralized identity platform that in fact does this, and we have some governments that are already looking at this globally. Although we have a major focus in Africa, we're already doing some work in Ethiopia in regards to this. So bringing all of this together, with every government in Africa would literally make a massive difference. And I don't want to, say much more than that, but I'd love to be able to communicate with, ministers on this. It's a game changer. Blockchain is here to stay. Yes,
Absolutely.
Blockchain holds cryptocurrency, but I'm not talking anything about crypto at all. I'm talking about a decentralized ledger that can hold, information on a public ledger and can utilize smart contract technology for certain use cases. I'll stop there.
So I guess Mandeep, the question then becomes who would hold and run that? A lot of African jurisdictions are only just developing their data protection laws. Many still don't have any in place. Those that do are just starting to put in place regulators, etc. Should that be purely a purview of governments, or is it an option for private companies to come in and run those kind of databases for and on behalf of governments?
That's a great question. I believe that if the governments play a big role in it and manage, because governments ultimately hold or issue the documentation, the identity documentation, etc. So today, most of the verification that's done by various fintechs and insurtechs, etc., those checks are conducted via APIs that essentially are querying government databases. So in essence, they would play a major part in doing all of the verification and adding the credentials onto blockchain. And then at that point, you and I as identities then hold and control our data. So let's say I approach a bank to open an account. The bank wants to do a check on my KYC data. I then receive a notification on my phone to say, Bank A has requested your verified credentials. Please consent and share, and I go ahead and do that. So I control it. So we would be in this Web3 world where the bank or the lenders don't have to pay enormous amounts to do all of these queries to 4 or 5 different databases out there. And this is very common in Africa. My driving license data is held by a different department to my national identity data, to my tax data, etc. If all of it was centralized by every government in Africa, and all of it gets put on blockchain, it will make a huge difference for everyone, and the governments can actually make revenue out of this for every check as well.
And hopefully that revenue is not made out of a Cambridge Analytica type organization.
Not at all, because with blockchain, it's non-PII, it's all trusted, secure. I can talk for hours on blockchain, and I won't do that, but anyone that I've received so much interest. As I say, I spend all my days talking to insurance companies and banks, and not only in Africa but globally, who are wanting these kind of solutions. And it's not just about KYC. It could be anything that has a use case. It could be fraud prevention in the insurance space, or the health insurance, for example. It could be in the case of loyalty. Today there are major telcos that have loyalty points, for example. They, but they're only allowing their customers to redeem against products on their side. If everything was tokenized, and when you bought an airline ticket, but when you arrived, say in the UK, you were able to use your tokens to hire a car with blockchain, we can do that. So.
Excellent. I don't know, Sheena, if you've got anything to add to that?
Yeah, just a few things. So yeah, I completely agree with everything that's said. And I sometimes when people hear blockchain, they think crypto, but actually the best thing about blockchain is the distributed ledger, not necessarily the cryptocurrency. But obviously cryptocurrency is sexier and gets more attention. But it's really the boring bits that's, and there's so many use cases. So and I think if you look at Ghana, there's some startups already working on this, right? Like Bitland, I think they're trying to use blockchain for the land registry, because land is one of the biggest issues. Kenya, West Africa, so imagine if you identify what land something belongs to. I mean, that's huge. Philips tried a trial in Africa, and then it got post. I think for ethical reasons, it had to be stopped. But it was really interesting in terms of the concept, which is they wanted to link vaccines to when a baby was born, just to make sure that the right vaccine went to the baby, because there's a lot of vaccines that get misplaced around the chain. Then of course there's around tracking and traceability of fruit, etc. So there are lots of use cases, and I think if you look at in Kenya, they set up the blockchain and the blockchain and AI task force. I think Professor Bitangademo is leading that. And if you look at that paper, and I know some of the recommendations haven't been acted upon, but I mean it's such an interesting paper with such practical recommendations. So I think we do, we kind of do have this kind of going forward. But beyond blockchain, I think there's I think there's simpler things as well that we can do, because I think to get to there, we will get there eventually. And I always think what's low-hanging fruits, what's medium, and then what's the future. And I think a low-hanging fruit, for example, and I think on this is all our data. So in Kenya, and I'll come back to Kenya, but in Kenya, all our data is digitized. We're not at the stage where we need to digitize our data. If you look at BRS, when you look at company records, etc., they're all within BRS, and they are open APIs. But the problem is that they are APIs where you can verify that information. And I think right now, if you want to verify something for a company, it's 650 shillings, right? So this individual search is 650 shillings. Now, the cost of doing that just increases the cost of doing business, and it's just a really archaic and a ridiculous model for the government. Imagine if they opened the APIs to private companies. So you have a subscription model, so the government is still earning money. All of a sudden, that data is available. Who are the companies? Who's registered? Where are the directors? So look at Company House in the UK. It's really weird. I tried to find out information for Kenya Airways, and I have to pay 650 shillings, and I still don't get financial statements, despite it being a requirement in the Companies Act that they need to be there. And yet I could get financial statements and directors by just simply typing Kenya Airways on the Companies House in the UK. And that information is available. So then what do they do in the UK? They have these companies like DueDeal who then help other companies with KYC, etc. So it's not it doesn't cost as much. So bringing down the KYC cost. Yes, the blockchain would be the ideal solution, but a very simple one that can be done straight away is get BRS to have open APIs to the private sector. And you're right, data protection is part of this. We have to make sure that we've got the policy, we've got the governance. But again, we are ahead here in Kenya. And if we did that and piloted with maybe 3 or 4 data points, see how that goes, and then you can scale it. all of a sudden, all that information, it's already there. It's not a big process of going to digitize it. Demo made sure we digitized everything in the 90s. So, we have that data. It just needs open APIs to be able to be shared with in an affordable way to the private sector.
I guess that kind of comes back to one of the first points you made on African regulators being profit centers. And your problem is, it's a lot of our governments are at the breaking point when it comes to national debt, which means they push down on all their regulators to collect as much revenue as possible, which inevitably stifles long-term growth, etc. So how do you those are two opposing views. How do you bring them together to say to the regulators that actually, look, that company search in Kenya that costs 650 shillings, you're still going to stimulate a lot more growth if you charge 50 shillings for it. And that's where you should be looking. How do we bring those two together?
So I think it's even more than that, right? Like, it's basically saying you're going to try and earn a different source of income. So if you start doing a subscription model where you say, all right, guys, if you're a company and you want to do 50 searches, you pay 1,000 bob a month, or your subscription fees are 50,000 a year, or whatever it is, and you bucket them into, what is reasonable. So obviously a bank that's doing 30, 50 searches a day should pay a bit more than like an SME who's trying to work with somebody else, etc. So you get the price point and you can do like a bucket list. But it's beyond that. It's actually more than that, because you tell the regulator you will earn more money, because now what you do is you're going to have a lot more data insights. And what you can then start doing is start saying, I'm going to publish monthly, weekly data reports on exactly the state of the SMEs, because you have all that information. Most firms, I know governments, funds, firms like yourselves, you will pay subscription models to get this data, because that's going to help you grow your business. Businesses will pay for that. So instead of thinking extractive, simple answers, think, how do you add value and charge premium for that service? Because you'll end up making more money, and you will, but it'll be making money, because I'm not anti-profit. I think, people should make money, but make money in a way that actually adds value rather than being extractive. So right now, yes, it's the money bit, but it's also a little bit of kind of laziness in your thinking, or it's also maybe not being aware of the different ways, which is why I go back to policy labs. When I spoke to a regulator, I said, you can do this, and you could people pay for this, and they were like, huh. Like, it was kind of like a aha moment, which is like, there's different ways of earning revenue, and we shouldn't be shy about that. Like CES right now, CES is a complete nightmare in Kenya, right? Like the way it's been calculated, but it's nobody's saying nobody needs to pay anything, but find out different ways that you can get your revenue without hindering the economy and also stimulating some value addition. Because if we had better data, how much more could the economy grow? And this is an Africa-wide problem,
No, absolutely. And speaking of Africa-wide, I know for me, I know on our side of the continent, regulators are very hard to persuade to go down that route. I don't know in Nigeria, West Africa, if it's an easier proposition, an easier sell.
No, I think it's probably the same thing over here, but we are seeing change, right? I think it might be slow, and one of the changes that we've seen is in relation to the Startup Act that was signed into law just last month, so a couple of weeks ago, and what that act does, which I think is very important to what Sheena was talking about, is it actually establishes a council that's made up of private stakeholders and public stakeholders as well. And so it codifies that in statutes, and then so it gives them really involvement in policy development and all of that. So we think that it's a good sign, because yes, historically it's very difficult to engage with regulators, and then the mindset is very, we're over here, you're over there, you do what we say, we won't listen to you. If you don't understand it, then we'll ban it, right? But we're seeing that I think everyone obviously recognizes how important tech is, and so we're also seeing regulators now set up innovation departments and all of that. CBN did that a couple of years ago. They set up a specific payment system department. So we're seeing all of that. I think obviously what needs to be done is those departments need to be staffed with people who understand tech, who have growth mindsets, and who are not just thinking, they want to be far removed from the process, right? Who are willing to, get down and engage and learn, who recognize how fast-paced and changing the nature of tech is. So yes, historically there have been those issues. We're hoping to see change based on new developments that have occurred recently, but of course, that's also down to implementation, and can only wait and see how all of that turns out.
So there is definitely some positivity there, and kind of as we come on to that, maybe if obviously from the audience, if anyone's got any questions, please do put them in the chat box, and we'll do our best to answer them. We talked about sandboxes as being positive. The second area which we're seeing changes, there's about 35 countries across the continent who are developing specific startup legislation, and that ranges from everything from tax incentives, financial support, and easing the costs of doing business. Now, obviously, it's a step in the right direction, but I'd be interested to hear your thoughts on whether you've seen it flow through as yet, and whether it's resulted in some jurisdictions gaining a foothold, becoming easier places to start your tech business, and others lagging behind. Sheena, Mandeep, I don't know from both your perspectives if you have any thoughts there.
Let me start there. So prior to joining Input Output Global and having come back to Kenya since 2017 and having been a co-founder of various startups, I in those days I found it challenging to understand, what was the best way to set up, the structure, because when you establish as a startup in one country, you want to scale in other, so you got Nigerian startups who want to come to East Africa and set up, vice versa from East Africa, they want to scale. It's understanding the process. It's complicated. It's long-winded. And having spoken, I have lots of friends who are CEOs of emerging fintechs, and they have structures that are outside of Africa because it's simpler, faster, and easier to do. Right? Honestly, there's no. Maybe I haven't done this, but I'm not able to find data out there that says, okay, this is the process to register a company in Rwanda, the process of how you do it in Nigeria, etc. Right? And it would be great, if it was all centralized, honestly, to be able to participate. You literally select the 10 countries you want to scale into, and you're able to establish quick and fast and follow, and adopt all the relevant regulations, etc. I'll stop there and sharing my experience there. And Sheena, please go ahead.
Hello?
Hi, Sheena, we can hear you.
Oh, sorry, sorry. Yeah. No, agreed. And I think, that experience, if we had that comparison, that would be really, really great. So mine is from kind of a different perspective, in the sense that when the startup bill in Kenya, when it was proposed, etc., there was so much excitement, etc. Obviously, Nigeria has done theirs, and we have a tech hub in Nigeria and South Africa. And it's funny, one of the things that we did at Kenya Innovation Week last year was exactly that, to say, what can we do, what can we learn from each other, etc. And what's good, and all of these things in startup builds. There's so many things that are really, really, good. But then again, it boils down to regulation, one aspect, right? But then there's other aspects. If I'm and as a failed startup, obviously a regulatory environment is really important, but most startups in the beginning aren't actually thinking about that, right? They've just I see a problem, I see a solution, I think I can make loads of money, and I think I can scale. And generally, that's kind of the mindset of entrepreneurs. They're problem solvers. They spot a problem and they want to solve it. The regulatory environment conversation comes when they're a bit bigger and they started seeing hurdles, oh, I have this great product, but I can't sell it because I haven't been certified, or I haven't done X, Y, and Z. So I think what was exciting about the startup bill, first of all, is finally, I think it's a recognition that startups are important. Because I think the biggest difficulty that you'll find, even right now, is the definition of a startup versus an SME versus an MSME, and they're used interchangeably. And the truth is they're both important for Africa, right? Startups are super important. High growth, hiring lots of people, solving challenges, using technology, for most of the time. SMEs, on the other hand, are just as important as well, right? They might be smaller, but actually they contribute to the economy. They're mass, they hire the majority of the people, etc. And they need both different types of support. So the startup bill is really, really good, and it covers startups who fall within that category. But then there's also support for the SMEs. And there's a sort of bit in between where both startups and SMEs need, and that's the business environment, right? They need a good business, whether you're a startup or not. You need to have clarity. like one of the biggest bugbears of businesses, from big businesses to corporates to small startups, is we just don't know what our tax obligation is going to be in the next 2 to 3 years, because there's no certainty. Things keep changing, and stuff like that. So there's certain key factors which I think, if done well, could, they don't just apply to startups, they apply to the whole business community. Certainty, clarity, a good legal system, court structure. And for example, in Kenya, they've done that, right, with the commercial court. They really tried. If you look at the ease of doing business reform, some of the reforms that have come up are actually super useful. But if you speak to most businesses, they don't even know about them. So sometimes it's also a lack of awareness of what's possible, because you get harassed by, county officials or whatever it is, because that's the culture. But actually, the law is pretty good, and it's pretty clear. So I think, in terms of the startup bill, I think the startup regulation is super important, but so is size of market, right? So for example, why do people choose Kenya, Nigeria sometimes as those markets to kind of go into? And why do they move? Like a lot of startups you see will move from Kenya to Nigeria, Nigeria to Kenya. They haven't, or Nairobi to Lagos. They haven't actually conquered the whole market, but they've started moving, across, because again, look at the population of Africa. The majority are low income. So it depends on what your product is also suited for. If you're sort of a higher end product, or you've got or it requires like a monthly subscription, etc., you're not actually going to scale within your own country, because you've actually nailed that market segment, and then you're going to move to a different market segment in the different African countries. So I think the start, so I think at the moment Zambia has done something really good around capital, and I think they're providing like soft loans and capital to kind of startups. I think Tanzania, Zanzibar is trying to attract everyone there, and I think a couple of the startups were thinking of moving their headquarters. Kenya, with constantly like a lot of these taxes and all of this uncertainty, a lot of the startups I've spoken to said, oh, we're not, we're going to move. And then there's the idea of, okay, I'll have my operations here, but then I'll register in Mauritius. Actually, Mauritius is now kind of losing the flavor of the month. But so a lot of these other African countries want to be seen to be, I want these startups to register here. But then you also have global competition, right? Like at the moment, like obviously I'd say Delaware has been, the country of choice for most African startups to register. But you've got London, you've got Amsterdam, and all of these kind of different places for registration. So I think I saw a really good article kind of comparing the different kind of startup regimes and kind of what was good, comparing what Kenya had proposed, South Africa had proposed, Nigeria had proposed, and actually I think Nigeria came up pretty strong, and they've gone ahead and implemented it. So really excited to see what they'll go ahead and do. But I think it's really, really important. And I think it's important because, again, it's made startups in the agenda. It's made people realize that, we do need to support these startups. They are going to be the ones who solve our problems and generate the much needed jobs. But I think it's not just regulation, and the regulation can be a catalyst. But what you'll find more is scale-ups moving rather than startups not starting to a different country. Unless you're an expat and you have all these different options. The reality is the majority of startups are started by people in that country. And to be honest, that's how it should be, because actually sometimes they understand the local context, they understand the local market, and yes, they should have partnerships and support from others. But I don't think it's a factor. I think it's where you're based, right? To the
No, thanks, Sheena. And actually, we've got a question from the audience, which is kind of related to that, addressed to you from me, in terms of how we ensure. So, question is, how do we guarantee enforcement of compliance if we go with standards and best practices as opposed to binding regulations? Now, obviously, it's a kind of rule of law question. If we don't have the regulations, then how do we have that certainty as to what the next decision is going to be?
So I think it's a good question, and we've already spoken about the ease of doing business in index. I think it would have to be moral suasion. So we have very clear standards. This is so this is the kind of laws that you should have. These are kind of infrastructure that you should have, government participation, etc. Right? And then if you have indices that measure compliance among the countries. I know that in Nigeria, it was always a celebration when we moved up a couple of points on the ease of doing business index. And so that may be one way that we can get government to start competing really for who's the best jurisdiction in Africa to establish and to build a startup. So I think that's one of the ways that it can be done.
So it is possible. And I guess it's that kind of interim step onto regulation. And then leading on from that, actually links quite nicely up to a second question from the audience. If we go with unified regulations, in what ways can startups and stakeholders in the tech ecosystem work with regulators to develop these regimes? given the countries are hesitant to see their sovereignty when it comes to standardizing regulations. And I think, Sheena, maybe you touched on that before, and it's probably through organizations like FSD, Africa, etc., that are best placed to do that kind of work.
Yeah, definitely. I think trying to do it on your own, I think is really difficult, but also there needs to be incentives, right? So for example, it could be, you know, certain, and you need to be able to incentivize the regulators so they'd be able to see what it is. And an intermediary can help that so that nobody feels like that they're losing out. So for example, with the IRA Bima Lab in Kenya, the reason why the other countries wanted to join the Bima box again was, well, the UK government, of course, we've provided funding for the Bima Lab and the sandbox, and it wasn't just funding. We also provided a kind of technical support, links to experts. We linked them with Lloyd's in London, etc. And then, and as a result of that, like 3 of the companies moved into the sandbox. And again, why is that a win? Because insurance penetration is low, and we're like this. And then the startups who moved into the sandbox can say, we're going to increase your insurance penetration. That actually meets your targets. So I think if you want to do that, you have to be very intentional and very strategic, which is, what is the regulator's mission, right? Like what are they measured upon? Like what is on their performance contract? Because their performance contracts are quite clear about what they need to achieve. Then you need to align what they need to achieve with what you're doing, and they'll jump at it. The problem is when we try and force what we think that regulators should be doing, especially when you start, it's not going to work. But if you're already saying, hey, you need to achieve X, Y, and Z, we can help you achieve this, they'll be more likely to join in. And then after that, you can say, you know, now you've done this, can you try and think about this? And all of a sudden, you've shown them a success story, and therefore you're able to do it. It's still not as simple as it sounds, but I think step 1 is really find the wins, get their performance contracts, really understand what is it you're trying to achieve, and then help them achieve it. And most of those regulators would have similar, like insurance regulators will, you know, yeah, protecting the market, protecting the consumer, but a lot of it is also, you know, we want to get more, you know, we want to increase insurance penetration in the country or whatever it is. So you just find that bit and you do it.
No, I think you're spot on. Actually, there's an interesting comment in the chat from Eric Mangi, who says, my experience was local regulators have huge knowledge gaps on the tech scene, as most are traditional lawyers, etc. If we have startup founders, creators working for the regulator, as for example in Singapore, then we would see a significant movement on this. And I think that's spot on. I mean, that's the way regulators need to be thinking. They need to be bringing in people from the ecosystem, whether employ them directly or at least just listening to them to get their point of view to see how they can help build an ecosystem that works.
And sorry, just to add to that, beyond that, you can do like policy fellowships, right? You can do secondments, you can do swapping, you can have a lawyer working in, like, you know, you can have a tech company, because you can even have techies coming and shadowing a lawyer just to see how they work. So it's a two-way thing. And I really agree with that comment, because I'm a lawyer by profession, by training, and with an MBA, but I'm a tech startup failed founder. And now I work in impact investing. So I worked on the investing side, and now I work for government. And I think one of my biggest skills is not, I'm an expert in anything, to be honest, but it's just that I now really, really understand how these different stakeholders think and communicate, and able to bridge that communication, because lawyers speak a language that techies just don't understand, and regulators just don't understand, and governments. And I think this idea of more secondments or like policy, like fellowships, where, you know, and it's a win-win, right? Like as law firms, you guys do secondments with your clients. Now, how great would it be if you did it with vice versa as well? The tech companies can come and see how you work, or government departments, etc. We're running a program called the Digital Apprenticeship Program. So it's called it's going to be rebranded as Sasa Kazi. And really, what we're doing is we're putting young techies in county governments to help them digitize for like a 3-month set project. And I think that's going to be game changing for everyone, because again, it helps the counties digitize, but really understand the tech, and it also helps the techies in the private sector ecosystem understand sometimes governments aren't being difficult on purpose. It's just that's how they're structured.
Oh, that's a very valid point, Sheena. And you're spot on lawyers. You know, lawyers are trained to just see the risk, and it's something we have actually struggled with. And one of the things we are thinking of doing, specifically when it comes to our VC clients and our VC investing, is that the way we go about due diligence is entirely wrong. At that level, it works for a PE, it works for the big M&A, but it doesn't work for an early stage VC angel investor. And we're trying to rejig our due diligence offering at that level to be much more targeted and focus on things like background checks, IP, cybersecurity risks, and even psychometrics on founders, which are much more pertinent and actually help an investor make a decision as to whether or not they want to go in. Whereas the traditional, 100-page due diligence that lawyers generally produce is really a waste of time. And I can say that being a lawyer. Unfortunately, we've come to the end of our time. I don't know if anyone's got any last comments before we wrap up. For me, anything to add?
I was just going to touch on a
Go
tool that I think is also available to regulators, which is considering what is known as alternative regulation or light touch regulation. And so rather than coming in and building the big stick, really, it's again just being more collaborative, right? Issuing guides, standards, and all of that, and just sensitizing the markets a bit more. And one of the reasons that, one of the things that we've seen is that there's a trust deficit, right, as regards how the regulated view the regulator. And even in Nigeria, even though we have currently 2 sandboxes, we're not quite sure what level of adoption has been. And I think that one of the reasons is, one sense, just some people just don't have all the information, and 2, people don't trust that they can actually go through those sandboxes without having any issues. So yes, light touch regulation might be a way that they then begin to sort of change the perception of the regulated.
I'd like to chime in briefly there as well on the light touch regulation. You know, I've been reading this, and I'm sure we all know this. You know, everyone knows that in Africa there are all 1.2 billion underserved or unbanked, right? Why is this still the case when the only reason you're unbanked is because you are undocumented, and regulations make it very complex, for you to be banked unless you are, documented. So regulations really need to work out and, strategies to simplify that. Someone getting a bank account that has a limited amount of, account transactions that they can do because of the, lack of KYC, but that builds some history, and that customer can then grow and increase the number of transactions, etc., by building a history and ultimately getting the documents they require. So, we should be also looking at, addressing this, because as I say, I constantly speak to banks and other companies around, the RegTech big, and regulations are very tight. There's no way around it, and it should be flexible. Yeah, in my view.
Absolutely. Sheena, any last thoughts?
No, I think agree with a lot of what my panelists said. I think though I think it takes 2. I think everyone talks about the regulators, but as startups, as entrepreneurs, as lawyers, we also have to engage with them and try and see where they're coming from. And I think doing more of this. So I'll just do a plug. I also sit on the board of Kenya, which is the Kenya National Innovation Agency, and we'll be having the Kenya Innovation Week in December. And I think one of the themes around that is also, can we bring the relevant regulators on board? The theme is global, so we're looking at global and local, and getting different innovators. So we're getting also people from like the Indian government, like Startup India, etc., to see if they've done better. I think we need to do a lot more knowledge exchange, like learn from each other, learn from other jurisdictions, but also talk to each other more and really understand where the other person is coming from before we can do it. I mean, regulators, it is difficult, and I think it is difficult for them to change, but I think they realize that they have to. And I think it's going to be the cross-border. So, for example, and picking success stories, like, for example, cross-border data flows would be data transfers. I mean, that would be amazing. And then you can move on to other things. So my approach with everything is pick something that you can do it well, like it's the agile startup approach, right? Do it and then scale. I think sometimes we're limited because we want to do everything and then it just doesn't start. So I think let's pick a few things that we can do, demonstrate those early wins, and talk to each other more, really. I think that's a big thing.
Yeah, no, absolutely. I think that last bit on the sharing of information is key. And when you mentioned pick a few things, so tomorrow's sessions, we've got 4 sessions running concurrently, one on FinTech, one on health tech, one on InsurTech, and one on general tech. So I hope you can all join us for those tomorrow. And yes, we'll see you then. Thank you so much for your time today.
Great, thanks. Bye.
Thank you. All right.
Thank you very much. Thank you.
Bye.
Goodbye.